I don't think there was a basis in either financial stability or price stability for raising rates yesterday. We've got inflation under control, on some measures even declining. If anybody thought there was complacency in markets a month ago, they certainly can't think there's complacency after the events of the last several weeks. So I didn't see the need for a rate increase. And I think the greater risks to the economy are turning over and slowdown rather than some kind of acceleration in inflation.
I guess one of the questions, Larry, is just how quickly the Fed ought to turn 180 on its outlook. If they've said we're not yet at neutral, we want to get to neutral, did they not send the gestures yesterday that they thought that they were moderating the outlook for rates?
Maybe they did a little bit, but judging by the market response, they didn't do so with sufficient force and in a sufficiently convincing way. I think we need a greater return to agnosticism on the part of the Fed. You know, sometimes there's predictions that they're going to ease and that they're going to tighten a great deal, as there was in October. Then there are predictions that are much more on the easing side, as there were several weeks ago. I think the Fed just needs to recognize that, just like the rest of us, it doesn't know what the future will hold, needs to proclaim its data dependence, needs to watch the ongoing flow of economic statistics very carefully, and needs to be careful about sending such strong signals.
So, Secretary Summers, given you disagree with what the Fed did and are worried about the outlook, you disagree, we know from having you on a lot, with a lot of President Trump's economic policies. Would you be an investor in this market? How would you be positioned? Are you in this market?
Oh, I'm not sure. I'm not sure I'm here to give economic advice. Usually, it's a bad idea for people to try to time markets and to move in and out a great deal based on some kind of assessment. The available experience is that almost nobody can time markets accurately. So my general advice to people would be choose an asset allocation between stocks and bonds, choose overall asset allocations that reflect your attitude towards risk, and then stick with it as markets fluctuate. Don't
I guess what I'm getting at
kid yourself that you can catch a falling knife. Don't think that you should panic after markets have just gone down.
What I'm getting at is how much do you think that the economic outlook for the U.S. has changed as a result of some of these tighter financial conditions? And what message are you getting here from the markets as it relates to the outlook?
Look, I think that you already had a lot of risks coming into 2019. You had the lagged effect of tightened monetary policy this year was going to kick in. You had an end to growing fiscal stimulus. And those two things, combined with a great deal of geopolitical uncertainty, combined with domestic policy uncertainty, meant that you were heading into a very uncertain and uneasy environment. And now you have added to that a high degree of volatility and uncertainty in financial markets. And so you add all that up, and the risks certainly look greater than they did a few months ago.